Now, as you look at claiming the benefits of a particular treaty, the first thing that you need before you can claim the benefit of a treaty is the proof of residence. What this means is that if there is a person who claims to be a tax resident of UK, he needs to prove that he is a resident of UK for tax purposes. If he is a resident, he will be entitled to the benefit of the India-UK treaty. But if he is not a resident, he will not be entitled to the benefit of this treaty. Which means that if he is not entitled to the benefit of the treaty, the taxation will be governed by the provision of the Income Tax Act. Right? This particular aspect is covered by Section 90, subsection 4 and Section 90, subsection 5 of the Income Tax Act. Let's just look at it. There will be no relief whatsoever which will be given under the DTAA. DTAA is Double Taxation Avoidance Agreement, or the treaty as we call it, unless a tax residency certificate, a TRC as it is generally called, is obtained from the government of the treaty partner country. So in order to claim the benefit of the India-UK treaty, the person has to have a tax residency certificate from the government of UK which says that he is a tax resident of UK. In addition to this, there are certain other prescribed documents which are required to be obtained. One thing I want to tell you here is that both these conditions are cumulative. You have to have a TRC, you have to provide these other documents. There is a Form 10F in which a declaration needs to be obtained, right? And when we talk about these other documents, so let's say in case of a business profit, generally the person who is making the payment should insist on a no PE certificate, which means that the person who is receiving the money, if he is getting business income, he should give a certificate that, not a certificate, it could be kind of a declaration that he does not have a PE in India, before the person who's making the payment does not withhold a tax. Form 10F contains certain basic requirements which are more or less the details about the tax status, I would say, of the recipient in the home country. The TRC could be in any format. There's no specified format which is there for a tax residency certificate, right? Different governments may give it in a different format. As long as the sum and substance is that the person is a tax resident, that should be okay, but is applicable to all kinds of assessees. It is not only the companies which have to get it. Even an LLP, if we want to take a benefit under the treaty, or an individual, they all are required to obtain a TRC, and it is required irrespective of the quantum of payment or the tax involved. Now, whether you are making a payment of $100,000 or $10 million doesn't make a difference. In both these cases, if you want to claim the benefit of the India-UK treaty, you have to have a TRC from the UK government, and you have to submit the other prescribed documents and information, some of which is given in Form 10F. Now, before we deep dive into the area of royalty and FTS, there are some basic things that you should know. The first one is that Article 12 deals with the taxation of non-resident. So if an Indian company is making a payment to a US company, Article 12 is only from the perspective of the US company. It does not deal with the fact as to how the deduction of expenses for the Indian company or the ICO is going to work. That's not the consideration for the Article 12. Second, unless redirected by Article 12, even if the non-resident has a PE or a fixed base, income covered under royalty or FTS is not taxable under Article 7 read with Article 5. Now, to explain this, let me put together an example. Suppose in my example, this US company had a PE in India, right? Just forget this for the time being. This US company was also providing services to an Indian company which made a payment to them for royalty or FTS, right? Now, the taxation for royalty and FTS works in a manner that even if the non-resident payer does not have a presence in India, it might still be taxable. The difference between these two forms of taxation is that when the payment for royalty and FTS is made by the Indian company, the tax which is withheld is 10% on gross basis. As against this, the profits of a PE in India are taxable on 40% on net basis. So the attempt that the tax authority may try and make is that they could actually move from this 10% gross to 40% net, or 40% net to 10% gross, whichever is more beneficial to them. But then, is that correct? The answer to that lies in this particular piece here. What this means is that if an Indian company makes a payment of royalty or FTS to a US company, it has to be dealt with strictly as per Article 12. Unless within Article 12 you have a clause which says that if the non-resident has a PE or a fixed base, and depending on whatever conditions are specified there, you have to move on to Article 7 or Article 5, you will stick on to Article 12. We will look at this when we see the clause relating to this later in the presentation, but Article 12 is a complete code in itself unless it asks you to go elsewhere. Only royalty or FTS up to the arm's length price is taxable under Article 12. We discussed this slightly earlier. If you pay $150, the arm's length price is $100. Article 12 deals with only $100. The balance 50 might be taxable either as a business profit or other income, depending on the facts of the case, but for Article 12, only $100 is relevant. And the last one, taxation in the hands of the non-resident may be triggered only when the payment is made. Just because the Indian company has accrued the royalty or FTS in its own books of accounts does not mean that the non-resident is liable to pay taxes. You need to watch out for what is the language of the treaty. Many a times you will find that the treaty will tell you that it is only the royalty which is arising and paid by a particular company that has to be taxed in the hands of the non-resident. So you need to be careful when you read a particular clause to see how this is applicable.